In this presentation, we will take a quick look at tax theory or types of taxes. Note that as we think about tax theory or types of taxes, it's not something that's really directly applicable to the actual preparation of the tax return. We're not going to be going through the 1040 right here, but it is something that is going to be useful for multiple different reasons. One is that whenever you do the tax preparation, you're often consulting or thinking about or talking to clients with it. And part of that conversation is going to be, of course, related to taxes. So some idea of the tax theory will be useful in order to do that large part of the job if you do tax preparation, which is to discuss that information with the clients. It's also useful to be able to just think about the tax process, to be able to take place and participate in the political process as well, because taxes are something that is going to be a major component of law that we want to keep in mind when we vote. Categories of taxation includes a flat or proportional tax, a progressive tax, and a regressive tax. The federal income tax will be a progressive tax, which we want to be able to compare and contrast to a flat or proportional tax, and then see how a regressive tax might apply to taxation as well. We'll start off with a flat or proportional tax, because that's going to be the easiest type of tax you would consider. If you were to think of what would be a fair tax to apply, the first thing that most people would think of is, well, why don't we put in a flat or proportional tax, which basically would mean that you're just going to apply a tax rate to the income. So if you're going to say, hey, we're going to have an income tax, how should we apply the income tax? Well, why don't we just have a flat rate that we're going to be applying to the income? So we need to know someone's income. We're going to take some proportion of that income using some type of flat rate. We're going to say, hey, we're just going to take 15% of your income. If you make less money, then you'll get 15% of the less money. If you make more, you're going to get 15% of the higher money. So it seems like a logical system in that regard. In other words, if you had a flat tax of the 15% and you had somebody that made $10,000, you would just say, okay, we're going to take 15% of the $10,000. You're going to be paying $1,500. If on the other hand you made $100,000, we're going to say that now you're going to take 15% of the $100,000. You'll be paying more tax. You'll be paying $15,000. So that would be the idea. In our tax system, our federal income tax system is not a flat tax. It's going to be a progressive tax. A type of tax that is more flat to some degree would be the FICA taxes. So if we're talking about Social Security taxes, for example, we would have something like saying that someone earned $40,000. We have a flat rate then of the 6.2%, and that would give us the amount that would be owed. If someone made $100,000 times the 6.2%, then of course they would be paying more taxes. So in this format, you could say, well, the Social Security is going to be a flat tax. But note, it's not exactly a flat tax either, because there's a cap on it. So there's going to be a cap that you get up to a certain point, and then you no longer pay any tax over that capped point. So just note this is an example then of, in practice, the laws can be kind of a mix in some type of way. They're basically having a flat tax with a cap on it, and this one also ties out, if you're thinking about Social Security, to the amount of benefits you're going to get at retirement. So note that when people put these words in place, something's a flat tax or a regressive tax or something like that, they're often using it in a very simplified term, and the tax itself is going to be more complicated. This will be calculated, the FICA or Social Security tax in this case, calculated as a flat tax. It's easier to calculate. It has that benefit of a flat type of tax. However, you can't really apply just a flat tax to it because there's other complications involved with the Social Security tax, including there's a cap on it, which kind of complicates the matter when you're depending on the issue that you're thinking about. And there's going to be the Social Security tied to benefits that will be received at the end of the time period in a retirement, or when they're qualified for benefits. And again, depending on what your argument is, which is usually from a political perspective, is it a fair tax? And it's fair, whatever, and you have to always think of fair in quotes. What does fair mean? Is it a fair tax? Is it a regressive tax? Those types of terms will be put into play, and it's always kind of more complicated, usually in practice. The benefits of a flat tax, however, is that it's an easy thing to do. It's an easy thing to calculate generally. And that's nice. It does typically result in the people that earn more will pay more, but then some people would say, well, they do pay more. They're paying 6.2% of the 100,000 in this case, as opposed to 6.2 of the 40,000 for the someone who earned less. However, you might say, well, we still think that they should be paying more than that, and therefore we might have something like a progressive tax. So a progressive tax will then actually tax people at higher rates as they earn more revenue. And so note, again, the flat tax would already be taking more total tax dollars if you had the same tax rate as people earned more money. But if we want to take more money as people earn more, as you earn more money, we want to apply a higher tax rate, then you have the progressive tax. This is what we're using. This is the income tax system that we have in the federal income tax. Now note, it's the most complicated type of system to calculate. And that means that basically no tax preparer actually does it by hand, because they use the software, pretty much dependent on the software. So what most tax preparers do, use the software to help calculate the taxable income, and then they can basically check that number with the tax formula, and then they're pretty much dependent on the tax software to help them calculate the progressive tax, because it's going to be using these different types of tables in order to calculate the progressive tax. It's a bit more, it's way more complicated. If you were to do this by hand, a flat tax, of course, you can just calculate with a computer or a calculator right there, or you can do it in your head, really. Use a quick calculator. Calculation. A progressive tax, complicated calculation, you can't do it as fast. You can't just take out the calculator, push a few buttons, and do one calculation to get the answer. Software, however, can do it very quickly. So the tax preparers are going to be using the software, of course, with the progressive tax to basically take that step. Now, it's going to be dependent on the marital status. Let's just take this single column right now to consider this. What does a progressive tax mean? That means that it doesn't mean, let's start with what it does not mean. If you're in the 10% bracket, and you say the 10% bracket ends at the 9,700, and then you earned one more dollar, let's say, to the 9,701. So now you earn that one more dollar to push you up to the higher tax bracket. You may have heard oftentimes people say, well, now I'm in a higher tax bracket, and I don't want to earn that last dollar because it's going to push me up into a higher tax bracket. Well, that last dollar isn't a problem, because it doesn't mean that the whole 9,701 is going to be taxed at 12% because you earned one more dollar. It means that you're going to be taxed at 9,700 at the 10%, and then that last dollar, the $1, will be taxed at the 12%, the higher rate. Now, if you then think that, well, the 12% is too high, I'm not going to work for tax at 12%, I'll only work for tax at 10%, then you might stop there and say, I won't work anymore if I'm going to be taxed that extra 2%, right? But that last dollar is not going to go retroactively back and cancel out the entire amount that would have been taxed under the 10%. And this is what makes it more complicated, because that means that we have to tax some portion of it, 9,700 in this case, at the 10%, and then whatever portion is above the 9,700 but not higher than the 39,475 at the 12%, and then add those two together. And so if somebody made then something between 39,476 and the 84,200 and was single, then we would have 9,700 taxed at 10%. We'd have the amount above, or the 9,701 to the 39,475 taxed at 12%, and then whatever amount is at over 39,476 but doesn't get to the 84,200 would be taxed at 22%. And so just the amount that's over the 39,000 would be taxed at that higher rate. So note that if you think about this, there is a disincentive to this, right? Because the progressive tax goes up, and so as you earn more money, the later dollars that you get do go up. If you get down to here and you go from 24% to 32%, you're saying, now if I earn over about 160,000, 161,000 or something, maybe you're saying from 24 to 32%, the amount of extra work to put in for that higher amount of tax that I would earn isn't worth my time. I'd rather spend my time on vacation or doing other things. That still is the case. It still is more disincentivizing than a flat tax. But it's not the case that if you get into a higher tax bracket, that all the prior income that you had earned is now at that higher tax bracket. You have to basically take the difference between the tax calculation. So again, to do that calculation with a calculator would be difficult because you'd have to do the calculation for each of these tiers. So that means that tax preparers are going to be very dependent on tax software in that way. So the progressive tax then has the virtue, and many people would say that they're going to tax more as the income goes up. The theory being, of course, that as income goes up, people are more able to basically pay the taxes and should pay the taxes due to the fact that they're able to do so. And the people at the lower end should have to pay less taxes because they're going to need the money more. They're probably living it and they're going to need to consume the money. The argument against it is that, of course, that it does have disincentives as the tax rates go up. I mean, if you're getting a higher tax rate, then you're less likely to work more at that point. Doesn't mean that you're going to work, doesn't mean you're getting all your income tax at 37%, but you might at the highest rate, but you might be saying it's not worth me working over the 35%. It is disincentivizing to some degree for performance. It could take away to some degree the amount of efficiency in the market, or how much willingness there is to keep on working past a certain point, but not as much as some would argue. When people mischaracterize this, they basically mischaracterize that argument by saying that if you jump to the higher rate, like all of your tax is going to be taxed at 37%, and that's not the case. Next, we have a regressive tax. And this is something that's often going to be used when you debate different types of taxes. You'll often hear politicians use the idea of regressive tax, and it's really something that's difficult to say exactly if something's regressive or not. Again, it's usually a little bit more complicated than to just say, well, this type of tax is regressive or not, because the taxes are usually a bit more complicated than just a straightforward type of tax, which is either a flat tax or a progressive tax. There's usually more factors involved. So a regressive tax is a tax rate decreases as wage base increases. So the tax rate actually goes down as the wage base increases. So the common usage of this would be if you're talking about politicians talking about a regressive tax, or people debating a regressive tax. It's basically saying the people that have less money are getting more of a burden of the taxes. So that you're kind of, in a sense, taxing more to the people that have less money, which of course is an argument that's going to say that's not a fair tax typically in that case. If anybody's going to pay more, it should be the people that have more money rather than the people that have less money, of course. Now, it's often said that something like a sales tax would cause this. So a lot of states have sales tax. If you go to countries in Europe, a lot of them have sales tax as their primary form of taxation. Now, it could be thought that, or oftentimes you could think, well, a sales tax could result in a regressive type of tax. Why would that be? Well, you can think of if you have a flat sales tax when you buy something, then you pay a tax, a consumption type of tax. If that's the case, then, and if you have a low-income individual, they're going to take their entire paycheck, 100% of their paycheck, and buy something. So if you have a 10% tax on consumption, every time you buy something in the store, they tax you another 10%, then the low-income individual is going to be paying everything that they earn to the store. So they're going to be paying 10% on all of their income. However, the higher income person is going to put some of that money in the bank and not be spending all of the money, and therefore they're going to be paying 10% on only the money that they spend, and that's why it's going to be a regressive tax, because the low-income individual is going to be paying tax on all the money that they spend, and the high-income individual is going to be putting some into savings. Now, again, it's usually not that straightforward, because you can think of a lot of alternatives to that. If you're a proponent of, say, a sales tax rather than an income tax, which is a common debate if you think about Europe and American types of taxations, you can say, well, yeah, but you can easily kind of adjust that or adjust components of that. For example, sometimes you could take food or primary consumption items out of it. So if you didn't tax things like food and electricity, primary essentials to living, which is what you would think basically all of the paycheck for low-income individuals would be going to, then they would no longer be paying all of their money to taxes for just consumption items. And then you apply the tax rate to all the things that would not be essential consumption items. And that would mean that you would probably be taxing wealthier individuals more, who would probably be consuming more things, buying more things, rather than just the consumption items. So again, it's just another example. If you were to hear an argument about, well, should we have a sales tax as opposed to a federal income tax? I'm not advocating either one. You'll often hear this argument. It will come up. It's going to say, well, the sales tax is going to be regressive, and then as if that's the end of the story. It's all over. That's it. But there's more there's more nuance than that. You can certainly think of circumstances where you could basically make a sales tax work where it wouldn't be as regressive of a tax. So we want to learn what these terms are, and we want to be able to hear when people use them, how they're using them, and then try to think, well, are they being fair with their use of them?